Greece's New Democracy Party won the second round of the country's general elections on Sunday, although the task ahead is now to forge together a coalition with the support of the PASOK party that backs the austerity demands from Greece's creditors. UBS currency strategist Chris Walker joins me now on the phone from London to discuss the Greek elections and its impact on the global financial markets. Chris, first and foremost, as we start a new trading week, how have the markets responded to Sunday's Greek election results?
Well, in similar fashion to the first trading session after the Spanish bailout, it's not been a particularly favourable reaction in Europe. The euro initially sort of gapped higher when Asia opened, but since then it's come under increasing pressure as the focus has quickly shifted to the sovereign debt markets, with Spain in particular, but also Italy under pressure.
The urgency now within Greece is to put together a coalition government which is strong enough to last and push through these harsh austerity measures. But with decades of political differences between the two rival parties, how easy or hard, shall I say, is this task going to be?
Yeah, it's undoubtedly going to be very tough. What we have to remember is that all three of the major parties actually wanted or proposed to renegotiate the bailout terms. So even though the markets have probably got the most favourable market-wise outcome, there's still a lot of differences on the political landscape. So it looks like we'll get a coalition between New Democracy and PASOK, but there are some arguments that PASOK may not give the vote of confidence towards New Democracy because they themselves fear that they'll permanently lose the vote of the left to Syriza. So there's a lot of sort of negotiations internally in Greece over the next few days, and it's clear that this market uncertainty is not being taken favourably by investors.
The other key is also how the European leaders have and will react to these results. Do you think they will perhaps show some leniency or allow a lightening of the bailout terms, now having elected a pro-bailout party?
Initially, we'd hope that they would perhaps give some slack on the terms of the bailout, but given that the statement didn't really include any signs of this, it seems a bit unlikely. In fact, we've got a spokesperson from the German government saying that the initial terms which were agreed need to be adhered to. So it looks like that any room for movement on the European front, on the Eurogroup front, is going to be a bit lacking. So I guess that's another reason why markets aren't really reacting very favourably.
We saw a bit of a relief rally, but nevertheless the vote still leaves the Greek economy in crisis and other Eurozone members struggling with their debt. So in terms of risk aversion and seeking out perceived safe havens for financial safety, do you think it's fair to say uncertainty and turmoil in the markets will continue?
Yeah, I think one of the main takeaways from what we've seen in this trading is that the problems are so deeply ingrained in the Eurozone that simply avoiding a severely negative situation isn't providing the markets with enough fodder to lead to a sustained rally, because at the same time we've had some negative data out of Spain in terms of the non-performing loan ratios, and Spanish yields rising about 20 bips so far this morning. So the point is that even though this immediate disaster or what would be perceived as immediate disaster in Greece has been avoided, the situation in Spain hasn't changed either. So in terms of what we like to hold, we still hold a moderately bullish dollar view, and we prefer sort of hedging to the downside via some sort of high BT euro crosses, the likes of euro yen, for example.
Looking at global financial markets and renewed volatility, is the focus now also on central bank stimulus and whether we will see some more action from perhaps the ECB or Federal Reserve?
Yeah, there's a lot of speculation of some monetary response, whether it's coordinated or unilateral. We have the G20 meeting starting today in Mexico, and of course Eurozone will be top of the agenda on that. In terms of scope for multilateral policy, we think it's quite low because interest rates generally are base or close to base rates, so any sort of coordinated rate cutting is basically impossible. And in terms of what else they could do, they already have the dollar swap facilities open, and then there's limited sort of dollar funding stress in the market, so on that front they can't really do much. So, but in terms of unilateral policy, there's a bit of speculation that the Fed might expand its balance sheet once again. We don't think it'll be the case this round. They may signal that perhaps they will expand Operation Twist a bit lower, but we don't think we're going to have a sort of outright balance sheet expansion through the Treasury market. If eventually they decide to push through more QE3, it'll probably be in the MBS market, but we think it's a little bit early for that to happen so far.
Chris, thank you again for talking to Dukas Copy TV. Now, coming up still later on Dukas Copy TV, we've got a press review of my colleague Monica Gibson and more on the Greek election results with Natalie MacDonald. But for the moment, goodbye.